If you're a beginner in the world of options and would like to start trading with a high probability strategy that's very simple to learn, this video was made for you. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to develop numerous 7 and even 8-figure per year traders. We hope you agree that you have found the right place to learn.
Hi, I'm Seth Freudberg, the head options trader here at S&B Capital, and we're in contact with traders and investors from all over the world who are looking for our advice on how to get started trading options. You see, with option strategies, unlike every other trading style, you don't actually have to pick which direction a stock or index is headed. You don't have to be either bullish or bearish. Instead, you can set up trades that will win as long as the stock or index stays inside a range of prices, up or down. And today's video is about a strategy that fits that description exactly. In today's video, we're going to be discussing how to win an options trade over a gigantic range of prices, both up and down. And you literally don't have to even think about whether you should be bullish or bearish, because this strategy works either way as long as the market stays inside that gigantic range of prices. So if that sounds interesting to you, then stick around, because most investors and traders don't even think that's possible. But with options, it most certainly is, and that's what we're going to be covering today. Now, before we get into the option strategy that we'll be teaching you in today's video, if you're absolutely brand new to options trading, you don't know much about how options work, we've put together a video for you to understand options basics. So click the video appearing on your screen right now if you need to get the basics of options trading. It's going to lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. The best way to teach you this strategy is by jumping into a specific example. So let's go back almost exactly a year to September 15th, which was the third Friday of September in 2023. And the reason that I mention that is that the third Friday of each month has traditionally been a date in each month where almost every stock and index has an options chain that expires that day. And since all third Fridays of each month are more or less 30 days apart, if you wanted to do a campaign of trades that expired 30 or 60 or any multiple of 30 into the future, you could do that, because there will almost always be an options chain that expires on the third Friday of every month, and those are published many months in advance in most cases. And so on that day, as you can see, the S&P 500 index, which trades under the ticker symbol SPX, had closed at 44.50.32. So let's say that on that day, a trader pulled up an options chain expiring on the third Friday of November, about 2 months away, which in this case was November 17th. And he looked at the column on that options chain, which is entitled Delta, and he finds the closest option he can to the 5 Delta option, which, as you can see, is the 4800 Delta call option. And he sells 10 of those, and then for protection, he heads up 25 points higher to the 4825 call option, and he buys 10 of those. Then he simultaneously heads down to the 3875 put option, which, as you can see, is the 5 Delta put option on that options chain, and he sells 10 of those. And then finally, he buys 10 of the 3850 puts, 25 points below that, for protection. And so when he does that, selling calls above the index price and selling puts below the index price, and then surrounding those by long options that he buys for protection, protecting the short calls with the long calls, protecting the short puts with the long puts, when he does that, he is entering into what options traders call an iron condor. And in a minute, you'll see how this trade works and why. Now, before we go any further, you might be wondering why we picked those 5 Delta options to sell on both the call and put side. And that's very important. So we're going to take a minute on this before we go on. You see, the delta of an option is a mathematically arrived at prediction of how much an option's price is likely to move based upon how much the index itself moves. And while it's a little bit of a complicated topic, suffice to say that an options delta has also been found to be highly correlated to the probability that an option will expire with value on the day that it does expire. And so, for instance, a 5 Delta option has approximately a 5% chance statistically of expiring with value, which means, and this is really important, that it has approximately a 95% chance of expiring with no value. And so when we sell a 5 delta call at 4,800, like we did here, that has only a 5% chance of expiring with any value on expiration day, which means that the index itself only has a 5% chance of expiring above 4,800. And therefore, it has a 95% chance of expiring below 4,800, which means that the 4,800 call option itself has a 95% chance of expiring with no value. And so obviously, the long option at 48.25 above that has an even lower chance of expiring with any value because it's even higher up the options chain and therefore farther from where the index is trading that day, which was 44.50. And with that exact same logic, just to the downside, the 5 delta 38.75 put has a 95% chance of expiring worthless. And the long put option below that at 38.50 has an even greater chance of expiring worthless because they are so far below where the market's trading. So we've placed index call options way above where the index is trading and way below where the index is trading. Now, why in the world are we playing around with options that have such a high probability of expiring worthless? Well, you're going to understand that shortly, and you'll begin to understand why people love trading options. Okay, so for you to start to understand why this trade makes sense, let's take a look at the cash flow of this trade, and it's going to become more and more clear to you. Starting with those 4,800 call options, you can see that we sold those for a price of $4.30. But remember, index options pay off at $100 per point. And so you multiply that by 100, and we sold 10 of them. So when you multiply it all together, you receive cash from selling those 10 calls in the amount of $4,300. But then you turn right around and pay out $3,300 for buying those 10 protective calls up at 48.25 using that same kind of calculation. Then, simultaneously, we sold those 10 38.75 puts, bringing in $9,400, as you can see from the calculation, and paying out $8,800 for the protective 38.75 puts. So when you net it all down, it results in positive cash flow of $1,600, as you can see from the calculations. And incidentally, your broker is going to be requiring you to have at least $23,400 in your account to execute this trade using a 10-lot trade size like we did here, because that 23.4 represents the worst case scenario loss on the trade. So if you're trading with a smaller account, then you can always just cut the lot size back to the size of your account, and your broker will cut down your capital requirement proportionally. So now let's head to the day this trade expires, about 2 months later on November 17th. And as you can see, after initially selling off, the index rebounded, closing at 45.1402 on the day this options trade expires. And so let's analyze the results of the trade. And so starting with the initial $1,600 in cash that we collected, if we turn to the 4,800 calls we sold, well, those all expire with no value because the index closed almost 300 points below their strike price of 4,800. So they won't pay off anything and simply expire with zero value. And of course, that's true of the long calls above that at 48.25, where those are even farther above the index's closing price. And by the exact same reasoning, the puts down at 38.75 and 38.50 both expire worthless also, because puts only pay off when the index closes below their strike prices, and they're located over 600 points below where the index closed, and so obviously those have no value, therefore resulting in the trader simply pocketing that initial cash flow that he got when he sold the Iron Condor in the first place with a profit of $1,600 for the trade. And that makes sense, right? Because if there was only a 5% or less chance of the calls expiring with any value and a 5% chance of the puts expiring with value, then it shouldn't be that much of a surprise that all of them expired worthless. And that, in fact, is why we say that 5 Delta Iron Condor strategies have a 90% probability of profit. And that's because if you subtract from 100% the 5% chance of the calls expiring with any value and the 5% chance of the puts expiring with any value, then naturally all of the options will have an approximate 90% chance or better of expiring with zero value, which means that you'll get to collect the full initial premium about 90% of the time statistically. Or putting it another way, at any price between 4,800 and 3,875, at any closing price inside that 925 point range, which is about, by the way, 20% of the entire index's value, at any point in that entire range, you would have made $1,600 on this trade. Okay, so at this point, with the index closing at 45.1402 and our capital now being freed up from that last trade, we can just run that exact same trade expiring 2 months later in January of 2024. And so let's see how that one turns out. So the third Friday, 2 months later in January, is January 19th. So we pull an options chain expiring on that date, which is 63 days later, so about 2 months later. And as you can see in this case, we sold the 48.75 and we bought the 4900 calls, and we also sold the 3950 puts and the 3925 puts. And again, just like last time, both the short calls at 48.75 and the short puts of 3950 were the 5 delta calls because we wanted them to again have a very high probability of expiring worthless, and therefore allowing us to walk away with all of the positive cash flow. And that cash flow in this case turned out to be $1,500, requiring $23,500 in capital. And in fact, iron condors will always have positive cash flow because selling options closer to where the market's trading will always result in more cash than you'll have to pay out for the options farther from where the market's trading, because that's the way every iron condor is structured. So in every case, the trade is going to be positive cash flow. And so if you think about it logically, in every case, you want all of the options to expire worthless, which, as we showed you earlier, takes place when the index closes between all of the options on expiration day. Now, let's move to the day that this options chain expires and this iron condor expires, which is January 19th. And as you can see, the index rallied quite a bit, actually closing at its all-time highs up at 48.3981. Now let's turn to our final value analysis, and even though the index had rallied nearly up to the short call strike of 48.75, it did fall short by about 35 points. And so both the call options expire worthless, and of course the put options expire far, far below the index's price that day. So those go out worthless also, resulting in, again, our simply pocketing the $1,500 that we initially collected when we entered the trade. And again, this shouldn't come as a big surprise because there was such a high probability of this being the outcome in the first place, as we explained earlier. And so now that you know how this strategy works, in the interest of time, we're going to summarize how a campaign of 60-day 5 Delta Iron Condors would have performed for the full year since last September, which you can confirm for yourself, by the way, if you have options analysis backtesting software, and I encourage you to do that. With that first November trade we showed you in detail, that one had a 925-point wide range between the two closest options, the short calls at 4,800 and the short puts at 38.75, and the SPX closed at 45.1402, as you remember. And so, as we explained earlier, that resulted in a profit of 1,600 because the index closed between all 4 options. And you'll also see that the January trade that we just covered is listed too, with its $1,500 profit on 23.5 in capital, because again, the SPX closing price on the day the iron condor expired was lower than where the calls were located and higher from where the puts were located, so they all expired worthless. On the next 60-day trade, which expired in March, we collected $1,550 in cash this time, because options pricing will vary from month to month for different reasons. And this time, our profit range was 5,200 to 4,275. And with the index expiring at 5,117.09, that closing price again is inside that range. And therefore, the options again expired worthless, netting us the $1,550 in cash. For the May trade, the range was 55.75 on the upside and 45.75 on the downside for an 1,100-point range this time, which can happen particularly when the market gets a little bit more volatile. The iron condor range will be wider. And this time, we also collect 1,550. And as you can see, the index closed inside that range at 53.0327, therefore well inside both the up and downside parameters. And again, we have a win of 1550. Now for the July trade, we collected a little less this time, 1450. And the range returned to that 975 points that the earlier trades yielded. And again, the index closed comfortably between the 5700 short call strike and the 4725 short put strike, resulting in yet another win. And finally, while the September 2024 trade actually isn't quite finished yet as of this taping, but this one actually has a very, very wide 1175 point profit range, as you can see. And we also collected a bit more than usual, $1,700. Now, the outcome is not definite until expiration, but if we were to close the trade on September 10th, when we're taping this, with the index trading so far below the calls and so far above the puts, it would only take a small amount, only $130, to close the entire trade because the options have so little value, being only 10 days to expiration, and the index trading so far from any of the strike prices of any of the options. And thus the cost to close it would be $130, leaving us with a profit of $1570 if we were to close the September trade right now. And so the total for the 1-year campaign was a profit of $9,220. And that means using the most capital we did on any of the trades, that $23,550 on the July trade, the return for the year would have been 39%, which is 4 or 5 times the average return of an equity portfolio historically. Yet, each trade had a 90% probability of profit to start with. And so I suppose you're beginning to see the attractions to options income trading like we practice here on our desk at SMB. And so what I'd like you to take away from today's video is that professional options traders have at their disposal very, very high probability strategies that are statistically sound and pretty easy to understand once you learn the basics. These kinds of trades are a great way to get started trading options income strategies because the likelihood of a win is so high. There are many other option strategies, many of which we've covered here on our YouTube channel. So I do encourage you to explore the rest of our channel's options playlist to get a more full understanding of how options income strategies work and why they're so powerful.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.